Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Adrian Orr, who is the CEO of the New Zealand Superannuation Fund. Thanks for coming in, Adrian. Good to see you.
Oh, a pleasure. Good to see you.
Now, you've had a stellar period of very strong returns in recent years. We have noticed, however, that both yourself and the chairman of the Guardians of New Zealand Super, Gavin Walker, have been sort of hosing down expectations somewhat of what we should expect in the future. I mean, you've done 17.47% in the year to May, I believe it was, and 10.3% per annum since inception, way back in 2003. So pretty strong, but you're now talking about something more in the vicinity of 7-8%. So what's the thinking behind that?
Well, the thinking mainly is to make sure that people understand we are a long-term investor, and looking at any annual return is kind of like taking a photo halfway through a marathon. It doesn't really matter who happens to be leading at the time. This has been exceptional. I think it's 20% over the last 3 years, and that is over 2 times our long-term expectation of returns for this fund. And we know that to get that long-term expectation, which is around 8.5% per annum on average over a 20-year horizon, to get an 8.5% average, well, you're going to have a lot of unders and a lot of overs and a lot of unders, and that will cause plenty of volatility, and so people get overexcited at both ends of those. During the GFC, no shortage of brickbats were flying at us. That was a time of great opportunity for us to be buying. Likewise now, markets have been recovered rapidly from the GFC, and we're saying, hey, the opportunities just aren't as exciting at the moment looking forward, and please don't accept this as the normal. We're not trying to foreshadow some crisis or challenge. We're as good at forecasting as anyone else, i.e. not good. We instead just set our course for the long term. At the moment, prices, share market prices are very well priced, so the value is very equal to the price of those equities globally, and so we'll continue to hold them, but we won't be overweight global equities. So the big opportunity space has largely diminished as the recovery has played its course post GFC.
Now, we've obviously had some pretty dramatic developments in recent times in the global economy. You're a global investor, obviously, so you watch these things closely. China, obviously the share markets there have fallen quite heavily, albeit off a very strong run-up.
That's right.
And obviously the Greek situation continues to play out in Europe. What's your take on, I guess, where the risks and opportunities are in the world at the moment? Yeah,
I mean, I'll make one, I suppose, glib point to begin with, is that at any point in time in history, there are challenges that everyone focuses on. In fact, we just had a board meeting earlier this week where we looked back over the last 30 years of geopolitical crises or environmental challenges, and almost to the point, every single issue we looked at was not the event that it changed much with regard to long-term investing. So there's always that noise, always that energy. I would say, just following from my earlier point, global equity markets are now looking very fairly priced. Where are the better opportunities? Generally where it feels most uncomfortable, and I would say Europe at the moment. Their equity markets have not recovered to any extent relative to the Asian markets, emerging markets, the US market, and so we're quite confident being a long-term investor in that area, and we see reasonable value there. So we're in that space. Global interest rates, I still just fundamentally believe they are well below any sense of long-term fair value. So we've been positioned for a long while now, and it's an expensive position to hold, but anticipating a rise in global interest rates, and that would be a good outcome. People tend to see it as a shock or a risk, but what that would be reflecting is real economic growth returning, average to low inflation returning. It's a good outcome. If you believe 2.25% US 10-year bond yield at the moment, you are forecasting a very sad global economy. and that's just not the case.
Now, on a different front, obviously the government contributions to the New Zealand Super Fund dried up way back in 2009, seems an awful long time ago now. They have set this sort of criteria for when they would resume them, which is around getting government debt under 20% of GDP. The current forecast is 2020-21. Now, obviously governments can change and the opposition have different views on whether they should be contributing to the super fund, but just wondering about whether another approach might be more appropriate in this environment. You guys are the biggest income taxpayer in the country. I dug a figure of 4.67 billion that you've paid in tax since inception now. Could, instead of resuming contributions, could the government perhaps just say, hey, you guys don't have to pay tax anymore?
I think they could do both. And I say that very optimistically, in the sense that all parties, current parties, agree that funding should resume. They all disagree quite on timing or how or when it should resume. And as you mentioned, the incumbent government is talking about a particular net debt level that they're targeting. Others are talking about an operating surplus, so on and so forth. So everyone agrees the big picture, which is it is important to pre-fund for this rising known future cost. When our funding formula is working as it is supposed to in the legislation, even though we pay tax, it is grossed back up with next year's contribution. So if we pay $1 tax, we get $1 extra for the contribution. So in that sense, it was a paper go-round. We believe it was put in there primarily to make sure that we weren't used as some kind of tax conduit. Our challenge now, of course, is that funding is not happening and hasn't happened since 2009, meaning the tax doesn't come back to us. It is lost to the fund, not lost to the government. And so that really means the current generation get the use of it, not the future generations that we're saving for. And that is a choice that has been made, but we just have to be very honest about the intergenerational implications of that choice. The opportunity costs are very evident. When you think about the returns, I think we estimate the fund would have been around $17 billion larger than what it is had the contributions continued as per the legislation.
Big numbers.
They are big numbers, and generally across most savings vehicles, sovereign wealth funds around the world, in fact, I struggle to think which ones don't, most are non-taxpayers. In a sense, they are off the balance sheet, so you don't have to worry about the volatility on Crown balance sheet and the income tax comings and goings. It's a separate saving investment vehicle that gets on to achieve its purpose.
In terms of these issues around government contributions and tax, I mean, do you discuss these with the likes of Bill English and John Key very often at all?
The facts are there on the table for all to see. We're known as the most transparent sovereign wealth fund in the world. The funding formula is actually in our legislation, so the whole population can go and look at what is meant to have come in, what did come in, and it even works out the difference for you. And so that's all there. The bottom line is that the decision has been made, and that's where it stands. It's meant to be a temporary halt. It is a long period between funding now.
Absolutely. Now, given the strong returns you've delivered in recent years, we've had a few discussions in the office, and I know it's cropped up elsewhere too, about whether you might look at launching a KiwiSaver fund anytime. Is that something you could do, and is it something you'd be interested in doing?
Again, it's that's our owner's decision. That is a political decision. Our stakeholders, the Minister of Finance, and our legislation is very clear what it is. What the public can do, of course, is look, because of our transparency, look at how we do our business. And the single biggest opportunity I see in the KiwiSaver world is just a simple, passive, listed reference portfolio. It could have 3 shades of grey, from, I call it as a conservative through to growth. But it's about getting a benchmark on what is the lowest cost, most efficient access I can get to the economic investments I'm after to achieve my purpose. The challenge across the KiwiSaver industry, it's not unique to New Zealand, is that you don't get to buy that. You get to buy that plus someone's purported skill. So you're paying for not just the vehicle, but the driver as well. And it's very hard to separate the performance of the car from the performance of the driver. But you have to pay for the whole package. So in our fund, you can go on our website, you will see the reference portfolio, and then you can see the actual portfolio from us being active, and so our value add is very transparent. We're running that. We can run the reference portfolio for about 25 basis points, quarter of 1%. We run the total fund for about 45 basis points. The costs of being active as well.
So, it's something you could do if the politicians deemed it appropriate.
Yeah, to be honest, I'm not sure it would need to be us. This is not rocket science. I think that people should step up and provide those offerings now. I can't see what's holding people back other than it might reduce some incumbent players' fees. That should be an available option.
Now, you've recently said that the super fund is potentially interested in investing in Auckland housing developments. There's obviously constant talk every day about the Auckland housing market for very good reason. What could you do in this area? And who would you be prepared to work with, and how much money might you be prepared to invest?
We will invest as much money as the opportunity allows. So we don't have any quantitative fixed set of investment. If we can get access to great opportunities, we especially love them when they have great scale. It might be just for example, in the housing area, it might be just in one subdivision, or it could be the same type of subdivision, cookie cut across different opportunities. We are fund managers, we're not builders, so we can provide capital, we can provide some capability around the overall financial management, but we will need to partner with people who have got the access to the underlying land and capability to build these structures. So it's a partnership concept where all the partners know their role. We're also happy to co-invest, so we're very close with Ngāi Tahu, Tainui, a lot of the major iwi who have great capability in this space. Some of them even have access to land. I'm hopeful, touch wood, that we can really get some of this stuff going. And for us, it has to be focused on that financial return.
Are you looking at any specific proposals at the moment?
I can't comment about ongoing, and the answer is yes, but I can't be specific about what they are. So, and we have been, we've come and gone. We're permanently in the marketplace, permanently looking for opportunities. The single hardest challenge for us is the partnership, and especially the access to scalable investment opportunities.
I'll just phrase that slightly differently. Yeah. In terms of Auckland housing, is there anything we might hear about from you in the short to medium term? I
would hate to predict, because if it worked, that would be great. If it doesn't, that wouldn't be great, whatever it is. And by the way, if current opportunities don't come past, we won't be stepping away. We are a long-term committed player, and property investment has its role like anything in a portfolio.
Now, you obviously were in the news earlier in the year over Portugal with the loss of about 200 million New Zealand dollar loan to the Banco Espírito Santo, and you've sued the Reserve Bank of Portugal, effectively, the Bank of Portugal.
That's it.
That case is before the courts now. How's it progressed thus far?
I would say positive, in the sense that we have our date in the UK courts. There's been no new information that's come that's made us go, I'm now less confident than I thought we were. If anything, quite the opposite. So, I have a strong belief we will get a fair and well-considered hearing in London, in the UK courts, and I hope to be able to bring news in relatively, in a reasonable time period, a pretty short time period, at least around the first stage. And the first stage is on what grounds can we have the main court case. Is it going to be in the UK legal system or in the Portuguese legal system? The UK is far preferred by us because it is about the activity, the substance of the case, rather than about just due process. You know, did the Bank of Portugal follow a relevant process in making their several decisions? So, you know, that's happening now, and I remain as confident as I've said to you before. It's not every morning you wake up, certainly on December 26th, and decide to sue a central bank. We are on strong ground.
Now, you mentioned the British legal system, Portuguese one. I assume the Bank of Portugal wants to have it in Portugal, do they?
Yeah, I would assume they probably don't want to have one at all, actually. They were quite comfortable with what they thought they had achieved. So, you know, I can't speak on their behalf. Yeah.
It does, without going into all the intricate detail of it, so we could be here all day if we did that, but it does it does seem somewhat that, I mean, obviously your loan was arranged by Goldman Sachs through a vehicle that they set up. It seems to be that you're caught in the middle of a bit of a fight between the Bank of Portugal and Goldman Sachs. Yeah. Are you confident that everything Goldman Sachs did was correct?
Absolutely confident. And I say that, I mean, we weren't even caught in a fight between Goldman's and the Bank of Portugal. It was as big a news to Goldman's as it was to us. You know, there's clear confusion between the arranger of a vehicle and the owner of that vehicle. I mean, we owned the vehicle. It was our money, not Goldman's. The fact of who put the wrapper around it could have been Doug, Wayne, Bruce, Mary, Sally. It's just irrelevant. You know, it was such a vanilla vehicle, 8 investors, 8 lots of capital in that, to do what Europe needs. That's a really frustrating thing for me, you know, away from the legal technicals. Liquidity provision is something that long-term funds can do and should do, and I would have thought we would have been invited in with ticker tape parades, to be honest, into the European banking sector, doing the right thing. That didn't mean that we ran in there thinking this is high risk. We took out very clear credit default swap insurance against that entity. Our cash remains with the new bank. Our credit default swap insurance remains with the new bank. In fact, it's worth even more now. It's just that the IOU went back to the old bank, you know, which was unprecedented to separate a credit default swap from the actual underlying asset. Just unprecedented.
Well, we'll await with interest to see the next developments. Now, obviously, farming, especially dairy farming, has been in the news almost as much as the Auckland housing market locally, with what's going on with dairy prices.
South of the Bombay, anyway.
Yes. Now, you did start building up a portfolio of New Zealand farms managed by FarmRight. I think there's about 12 farms.
Yep, we've got a dozen. Yep.
Now,
we like to do things in dozens.
Just wondering whether you might see an opportunity to buy more, you know, if land prices follow dairy prices down.
Yeah, and as I was just chatting briefly, I mean, the answer is we haven't bought a dairy farm for over 2 years now because of exactly where pricing went, and it just wasn't fitting our math. We were thinking you're just not being rewarded for the specific idiosyncratic risk that comes with farming. Of course, commodity cycles being one of them. And so we've stayed out of the market, and so we're very pleased with our portfolio. We are going to be absolutely watching over the next couple of years. One warning: so's the rest of the world at the moment. You know, agriculture is the new black for global fund managers. It's a very tough asset class to get exposure to. You literally have to buy farm by farm. You can't come in and just buy the index or the corporate. But we will be watching very closely. We still have a bigger appetite than what we have in terms of investment. And we're also looking globally across many agricultural opportunities. It will be really interesting just to see what actually happens to these farm prices, because you know, with a wall of capital, whether they follow the commodity price down or not, it's going to be fascinating.
It's going to be an interesting watch. Now, you obviously have external managers who help to manage the super fund's money. One of them has been Milford Asset Management locally. Obviously, the Guardians of New Zealand Super suspended their mandate earlier in the year, pending the FMA investigation. Where are things at with that? I mean, are Milford going to be reinstated or cut adrift, or
we've left them where it is at the moment. So we still have a mandate with them, but we just have no cash in the mailbox. And so it's sitting there. We just want to let some water go under the bridge with them. They have been busy investing significantly in their middle and back office. They've got a new portfolio manager running the part that was looking after our money. We want to see how that shop works together. And, you know, it's not going to be soon. We'll chat to them over the course of the next year or so and progress. We still really like the whole concept of active listed management in the New Zealand equity market. And so we are always looking for opportunities to be able to deploy our capital across solid managers.
Just wondering, obviously with the scale of the New Zealand Super Fund, I mean, is there any danger that you become too big for the New Zealand markets?
I think there is a real danger. That's been lessened by the fact we're not being funded. But our fund, if you saw it, its growth has been pretty similar to over recent years to the growth of the New Zealand capital market anyway. And so as a percentage or proportion, we haven't moved much. So even though the dollar billions has grown, as a percentage of the total market, it's been fine. But it's something we watch all of the time. One of our major concerns is not necessarily just how much of the total New Zealand market, but how much with any one individual manager, because they have specific strategies that have constraints. You can't be nimble and active if you suddenly become large, and so that's one of our number one constraints, is just the size of the managers that we've got.
Now, look, just finally, Adrian, you've now obviously been in the job as CEO since 2007, about 8 years. Just wondering, what are your plans? You still enjoying it and planning to hang around for a while yet?
You assumed that I was enjoying it. Yeah, no, absolutely. I mean, we've got a fantastic team. We've got a dream investment mandate, maximise return without any of these fettered asset classes, geographies. We've built a world-class culture there now, and having done all that hard work, why wouldn't I sit there and enjoy it for a while? Yeah.
Fair enough. Yeah. Good on you. Thanks for coming in.
Cheers.
That's Adrian Orr, CEO of the New Zealand Superannuation Fund, and I'm Gareth Vaughan at interest.co.nz.